Banks haven't been doing well, as you may have noticed in the news over the last few weeks. You also might have heard about the recent news about Silvergate and Silicon Valley Bank, wherein the latter clearly dominated the news cycle about a week ago after they experienced a run on the bank from depositors, causing them to sell their portfolio of government bonds before maturity at huge losses. However, that was not enough as depositors attempted to withdraw $42 billion in cash from Silicon Valley Bank in one day, prompting the Federal Deposit Insurance Corporation, or FDIC, to sweep in and seize control of the bank. It was huge news, but believe it or not, it didn't end there. Similar problems have since been reported at two more US banks, Signature Bank and First Republic. However, Credit Suisse has dominated the news this week following their collapse, which resulted in a $3.3 billion takeover from UBS, as well as lifeline support from the Swiss National Bank. But what exactly caused this crisis? And is it just another domino in the global banking system's collapse? Hey, welcome to Stock Market Mate. Today we'll talk about our take on the current banking crisis. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right to it. Interestingly, Credit Suisse's demise bears few similarities to the failures of US banks. In the case of Credit Suisse, it was a long series of scandals and underperformance that eventually brought it to the brink of bankruptcy. As evidenced by the long-term stock chart, the bank has witnessed nothing but negative pressure on its shares since the recovery from the global financial crisis, losing more than 95% of its share value. In reality, the chart from Reuters says it all. Since 2020, they've seen the fallout from their spying scandal in which they were snooping on ex-employees, as well as the green sale lobbying scandal, the loss from Archegos default, and who can forget Credit Suisse's failure to prevent money laundering by a Bulgarian cocaine trafficking gang. As the chart shows, each of these blunders adds more and more negative pressure on the stock price. More importantly, it leaves a sour taste in the mouths of Credit Suisse's depositors and clients. They earned the reputation of being a shady bank, and over time, less and less people wanted to do business. This resulted in the bank choosing a new CEO, Ulrich Körner. In July of last year, and in an attempt to turn things around, he revealed a new strategic plan for the business, but failed to win over investors. The new plan was supposed to coincide with a large capital raise, which alarmed investors and drove stock prices down. This was in the fourth quarter of last year, and we now know that they saw net assets outflows of 110.5 billion Swiss francs during that time period, as well as their worst annual loss since the global financial crisis of 7.29 billion Swiss francs, or around $7.89 billion. So they're coming off pretty bad results in the fourth quarter. To make matters worse, the chairman of Credit Suisse's largest shareholder, Saudi National Bank, stated that the bank would not buy any more shares of the Swiss bank, stating that they wanted to keep their ownership under 10% in order to avoid the extra red tape that comes with a much larger holding. This announcement, combined with the failure of Silicon Valley Bank the week before and the immediate concern about the strength of the global financial system, caused Credit Suisse's shares to fall 20% in a single day. They were then brought to a standstill. Years of scandal, poor performance, and more recently customer withdrawals, massive losses, and investor concern all contributed to the company's demise. But then the next day, Thursday, March 16th, a lifeline. According to a press release issued by the group, Credit Suisse is taking a decisive action to preemptively strengthen its liquidity by intending to exercise its option to borrow up to CHF 50 billion from the Swiss National Bank, or CNB, under a covered loan facility as well as a short-term liquidity facility, both of which are fully collateralized by high-quality assets. What exactly does this mean? Well, it means they went and spoke to the Swiss Central Bank, asked for help, and the Swiss bank said yes. Not gonna lie, this was a very smart move for the bank, as what it does is alleviates the short-term panic around another potential liquidity crisis, which of course causes a run on the bank, which was what we saw happen last week with the other US banks. So the Swiss bank came into the rescue and all was saved, right? Well, no. The story can't just stop there. No way. Only 3 days ago, Credit Suisse announced that it would merge with UBS with the assistance of Swiss authorities. As a result, the Swiss National Bank issued a press release stating, UBS today announced the takeover of Credit Suisse. This takeover was made possible with the support of the Swiss federal government, the Swiss Financial Market Supervisory Authority, FINMA, and the Swiss National Bank. With the takeover of Credit Suisse by UBS, a solution has been found to secure financial stability and protect the Swiss economy in this exceptional situation. Both banks have unrestricted access to the SNB's existing facilities, through which they can obtain liquidity from the SNB in accordance with the guidelines on monetary policy instruments. The substantial provision of liquidity will ensure that both banks have access to the necessary liquidity. Overall, UBS will pay $3.2 billion to acquire Credit Suisse, with Credit Suisse shareholders receiving 1 UBS share for every 22.48 Credit Suisse shares. This is actually a positive consequence because it means the bank will continue to operate. However, it is far from flawless, as nothing is. You may have read recently that certain Credit Suisse bondholders are very upset about this agreement. According to the Swiss regulator FINMA, the 81 bondholders would be wiped out as part of this arrangement. That is unusual because bondholders are normally paid out before common shareholders. However, even though shareholders aren't doing particularly well in this scenario, they're still receiving something. They've got 1 UBS share every 22.48 Credit Suisse shares, whereas the 81 bondholders receive nothing. So it isn't perfect, but the general consensus is that it's probably the smoothest thing that could have happened. But we guess the really big question is another domino falling in a much bigger global banking crisis? Although while we're certainly no expert in the field, it does seem as though the consensus right now is no. And even investors such as Michael Burry have come out and said very similar things lately as well. He said recently on Twitter, quote, "This crisis could resolve very quickly. I'm not seeing true danger here." Steve Eisman, another man represented in The Big Short, recently went on CNBC, saying he doesn't see another 2008. So it doesn't seem like this will eventuate into a full-blown banking crisis, and we think that there are really two reasons for that. To begin with, there does not appear to be a huge systemic issue in the banking system. Yes, interest rates are rising and individuals are running low on cash, but this is not a systemic issue. Silicon Bank, Silvergate, and Signature Bank, for example, all messed up because they operated in highly vulnerable business areas while simultaneously mismanaging their interest rate risk. As a result, when their deposit was depleted, they were forced to liquidate their bond portfolios at a loss in order to pay the withdrawals, which inevitably destroyed their ships. In the case of Credit Suisse, the story wasn't the same, but in this example, it again wasn't a systemic issue. Rather, it was just a poorly run bank that had been slowly dying over time, and everything came to a head last week. Number 2. It's clear that central banks around the world are watching the situation like hawks and are ready to intervene promptly to prevent a confidence crisis. The FDIC, Treasury, and Federal Reserve declared last week that they would guarantee all deposits at Silicon Valley Bank and Signature Bank, despite the fact that the rules state that they should only guarantee the first $250,000 per customer. In response to the Credit Suisse situation, the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, and the Federal Reserve and the Swiss National Bank announced coordinated action to improve liquidity provision through existing US dollar liquidity swap line arrangements. Central banks are taking steps to assist the banking sector, which helps to reassure investors and prevent a chain reaction of bank runs. So while we're not experts in the field, our research suggests that this is less likely to be a major issue like what we witnessed in 2008. Well, that's about it for today's video. If you liked our content, or if this helped you, do give us a like and subscribe to the channel. Thank you so much for watching, and we'll see you at the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!